As you guys have always heard me say, your network is your net worth. It wasn't until 2016 is when I started to interact with other accredited investors. Up until then, I was just some kid who had 11 rental properties and I thought I was on the top of the world. But boy, did I start to learn about these tax benefits and these real estate syndications. And then now, as maturing more and more, always trying to learn, I'm always trying to see what's on the next horizon. We've been dropping hints on private equity, venture capital projects that we're looking at, always talking to business owners and operators, trying to get more involved in going back to community and your network, right? That's why we have our mastermind group. Suggest everybody sign up for our group at thewealthelevator.com/club. But what I'm always the person who tries to pioneer and move into higher level areas. A couple groups I'm a part of, EO, Entrepreneurs Organization. I think you need to have $1 million revenue in a business a year to get in. And then I'm also part of Vistage, which is a lot more C-suite president's level. I think that one also has $1 million threshold. But that's where I found today's guest, Bill Snow. He's a seasoned mergers and acquisitions professional or investment banker. He's been in there for 30 years and most known for author of the mergers and acquisitions for dummies, the yellow book. So you're actually the second person who were the Dummies author in my network. Bill, thanks for jumping on. Looking to dive into this world as I think I didn't know this world existed 5 years ago myself, but appreciate it.
Thank you for that. The plug there. Yeah, the Dummies book, that is our second edition. First came out in 11. The second one came out last year.
A lot of the folks out there have professional backgrounds. Maybe just to understand, where did your road lead up to before coming an investment banker?
Good question. I'm still trying to figure that one out. So I finished college. I had no idea what I wanted to do. And so I bounced around aimlessly. I had sales jobs. I worked for an insurance company. I worked for a theater company selling group tickets. I went to work for a retailer and I was helping make acquisitions in the field. We were rolling up mom and pop retail operations and I was managing those. Got interested in what is the genesis of a business? Where do these ideas come from? How they get started? So I went to work for an angel funded company and a venture funded company and was banging my head against the wall for quite a bit. It got to a point in my career where something I was working on didn't come through. And I had been offered a job at an investment banking firm and I wisely turned it down 4 or 5 times. And the owner of that firm caught me at a moment of weakness and said, I'm not taking no for an answer. You're going to be an investment banker. Yeah, and I was in my late 30s when that happened. I said, okay, fine. But I really enjoyed it and did very well. I enjoy the whole process of creating value for others. What you need to do is be able to write, be able to do math, high school, algebra and calculus, and accounting. You better be an expert at accounting. So if you can write, if you're good at math, good at accounting, and you can speak and read a balance sheet, you might be able to do this kind of.
So most of us are goal oriented, but investment bankers make a boatload of money in this business. But if I'm reading between the lines, at least for some of us with kids, right? Like you had a little bit of sales background, that was
Sure,
the skill set, and then you build
sure.
upon that. But I think if I'm reading into it, is you just got hooked up with the right opportunity with the right smaller group, right?
Yeah, exactly. So everybody says, how did you get into investment banking? And I said, I couldn't do anything else. So I had to go be an investment banker. And it just turned out well. Probably the biggest skill set, though, in this work that I do is poker. Not that I'm any kind of expert at poker. The most important thing is I look back to all those poker games and it's not bluffing. People who don't know what they're talking about think poker is bluffing or they think it's a big movie, very theatrical type stuff. It's reading your hand. It's understanding when you have a good hand, when you have a bad hand, and understanding how to play that hand. If you have a weak hand, you better get out as quickly as possible with as little damage. If you have a strong hand, you need to play that accordingly because if you overplay a strong hand, what are you going to do? You're going to chase everybody away. And so that is, I think, the biggest lesson in poker and also in M&A. If you have a strong hand, that's great. But if you overplay it, you're going to be left with nothing. And so understanding that way, your position relative to others, I think by far is the most important thing in the investment banking world.
Yeah, so let's start at the basics here for folks. Investment banking, you think of Morgan Stanley, like a lot of these bigger Wall Street firm names. Break it down to us. What exactly do they do? Give us the dummies version.
Sure, sure. Investment banking, we do nothing with investments and we're not a bank. So of course we call ourselves investment bankers. It's a fancy term, and I think we use it to feel good about ourselves because we're not a profession like legal or accounting or architecture or medicine or things like that. Investment banking basically means you are somebody who helps do something for a business, raise capital, sell the business, help acquire another business, something where you're going to be affecting the ownership portion of the balance sheet. Lots of different flavors. So I do nothing with the stock market. I am not a stock picker. I stay away from that. So don't ask me for stock picks. I work with privately held companies. And these are companies that typically are in revenue range of maybe about 10 million to 300 million. Owner wants to do something, quite often sell, probably wants to retire. That's the main thing that we get involved with. Somebody that has a business, time to retire, find a new owner. So we will run that process and find that new owner. We will also help typically larger companies or private equity firms if they want to make acquisitions in that middle market, lower middle market space, roughly 10 million to 300 million in revenue. So we will help make acquisitions. And the acquisition work is brain damage work. I do not recommend it. Stay away from it, people. It's really hard. I look at three portions or three parts in that. You have the search, you have negotiate, you have finance. Finance is the easiest. There's money everywhere. Negotiating, that's the fun part. That search part, trying to find a good acquisition, is one of the most difficult things that you can undertake in business.
And that's why you sponsor our happy hours at these groups, like the CEO groups that I'm a part of, and that's how our roads cross. So you weren't just doing it to be nice to us. You were trying to find presidents,
Sure.
owners, CEOs.
And for those presidents and owners and CEOs who might be watching this, think about if you want to make acquisitions, think about it from the other side. How many overtures do you get? How many phone calls and emails that do you get? Hey, do you want to sell your company? And how often have you sold your company? How often do you react to that? What is your reaction to those overtures? You probably just delete those, maybe even give somebody an earful. And so if you want to make acquisitions, don't do what everybody else is doing because you're going to have the same bad result. And it is hard. You can't go to a store and buy a company. It is hard to find a company. For the sellers, finding a buyer is easy. Getting a deal done that makes sense. That's what's very difficult with business.
I'm curious on what your initial knee-jerk comment is to this, but if people know who Cody Sanchez are and Alex Morsey, these are a couple of social media influencers out there that are big on talking about buying laundromats, little vending machine businesses, small stuff, like stuff Bill
Sure.
doesn't really want to deal with because it's just too small cap. But they're out there on making YouTube videos and they think that they're going to find business owners that way. Unfortunately, all they find is broke guys who don't have enough money to buy a rental property. And obviously, they make money off of programs to do the thing, which very little people are successful in making a business. What Bill here does is he goes after that next layer.
I have no idea. I'm the
Yeah.
biggest hypocrite in the world, Lane. I have never watched or listened to a podcast, and I've been interviewed a bunch of times. I don't read business books, yet I've written a bunch of them. So I'm the biggest hypocrite in the world. I get nothing from reading about business. I read the Wall Street Journal. Don't know anything about them, good, bad, or indifferent. I just know that everyone's always looking for the quick shortcut, the easy way. I want to make a lot of money without working. Hey, that sounds great. And they always think they're the only person in the world that's thought of that. It's rarely that easy where you can put something in with very little effort, very little money, and make a fortune. For me, finding acquisitions, it's tough to call up people I don't know. So I market to people who have the ear of a business owner, lawyers, accountants, wealth managers, commercial bankers, people like that. And I try and stay top of mind with those people. So when they have that conversation with a client or somebody that they know, and that conversation leads to maybe the time is right to sell the business, I want to have my name on that list. You need to talk to Bill. They'll probably give him a couple names and that's fine. But that's how I find my opportunities by doing things like that. Marketing
Yes.
to people who are influencers, real influencers, lawyers and accountants. Accountants are tough because they don't want to talk to anybody. Lawyers are difficult because they can't stop talking. So there's a happy medium with the right accountant and the right. That's a joke, everybody.
Yeah, and I didn't wanna make Bill look like catch him off guard there, but I just wanted to show the bifurcation for everybody out there. Cody Sanchez, Alex Hormozi, or like in the real estate world, for example, like Grant Cardone. If you talk to your good operator who's actually operating, nobody knows who the hell Grant Cardone is, folks. This is where I think what we've tried to transition to in terms of deal finding is moving past these internet people in these like guru groups or these training programs and get to people who actually have a track record and it's so much like your network is your net worth. That's why I joined these professional organizations, meet with guys like Bill. So, Bill, we find a good business owner. Let's talk through an example. I know you have confidentialities, but maybe we can just give people like a working business kind of to go through, maybe walk us through the process, right? You find an entrepreneur who is ready to retire, maybe take us through there, the process.
Finding a business owner that is ready to sell is very difficult. I would have your people make some phone calls, call up some businesses. Hey, I'd like to buy your business and see what the reaction is. Finding those opportunities are hard. So usually I get referred in by a trusted source, like I said, a lawyer, accountant, wealth manager, people like that. So if I do have that opportunity, I was just talking with someone a couple days ago. Actually, I'd done some work a few years ago with the company. They decided to take it off the market. Now they're thinking about going back into the market. And so what we do now, I'm representing the seller. Okay, remember, at M&A, you've got buyers and sellers. There's two sides here. So if I'm representing seller, I'm going to put a buyer's list together. Okay, I'm going to put all the materials together, present the company, explain what they do, show the financials, of course. Then I will reach out to those buyers, those strategic buyers, other companies, in other words, maybe private equity firms, if the owner is okay. And we find those buyers typically in something called capital IQ. And it's tough to reach out to individuals and stay in touch with thousands and thousands of prospective buyers. It's just impossible. So everybody always thinks that we have a listing of all of our stuff ready for sale. We don't do that. We put a list of the buyers together. And so if someone's interested in making acquisitions, first of all, why would you want to do that? It's a lot of risk, but that's the right opportunity. How do you find those opportunities? Are you, first of all, prepared to operate the business? What are you looking to do? Does that meet your investment criteria? Do you just want to be an absentee owner? Do you want to operate the business? Those are some of the questions that you have to ask. And if you want to make acquisitions, I would put a short list, 10, 20 companies together, reach out to those owners of those companies. Instead of just saying, I have money and I want to buy you, I would come up with a question, something that you can talk about, a thesis, in other words. I'm seeing something in your industry. Would you be interested in getting together to talk about this? I'd like your opinion. That can be a way to start a conversation, but trying to find those opportunities to buy.
Yeah, so pretty much like a small chance here, just throwing it out. But if anybody has a buddy or they are looking to exit their company, reach out. Maybe we can connect you with Bill here. Maybe that might be a start of a lead. But let's just say that magically that happened, right? What's like the next step? Maybe take us to the process.
I've got a client and the owner wants to sell the business. And so the process, if this is what you want, process is we put a book together. It's called a confidential information memorandum, or SIM. We love acronyms in this business. We put that buyers list together. And then we, the investment bankers, reach out to the prospective buyers. The buyers have been approved ahead of time by our client, the business owner, the seller of that business. We send a teaser out, which is a blind teaser, does not have the name of the company. If the prospective buyer is interested, they sign a confidentiality agreement. When we get that, then we send them or email the deal book, the confidential information memorandum. Based on that book, we ask for an indication of interest, and that is typically going to have a valuation range that a prospective buyer is willing to pay. Based on those indications of interest, we'll usually have a due date. We'll set up 5, 6, 7 meetings with prospective buyers and the seller, give the buyers an update, a chance to interact. And then after that meeting, we will ask for a letter of intent, which is a more detailed offer. It's going to have a specific value instead of just a valuation range. It will have a specific number. We'll probably have some negotiating and horse trading. And at some point, we will sign the letter of intent. We go through due diligence with that one buyer, and then we close the transaction. So those are the basic steps in selling a business.
Now, in this situation, is the operator, the old business owner, staying on board, or what's normal with the QC or the spread?
It depends what they want to do. And so there's no right or wrong. So a business owner might want to sell all the business and retire. Business owner might want to say, you know what, I want to sell 70, 80%, work for a few more years, hold on to a little piece and then sell the rest. I just want to create a small bit of liquidity, maybe sell 30, 40%. So I have a majority stake, put a little money in my pocket, and then maybe look to sell in a few years. So there's no right or wrong. Most buyers are going to want the business owner to stick around for at least a transition period. What is that transition period? 3 months, 6 months, a year. It's really going to depend on the company and the situation. A business is worth the most if the business owner is not needed. And that's sometimes a bitter pill for business owners to realize. But if you're not needed day to day to run the business, it's going to be worth a lot more. And so you're going to need some sort of transition period.
Yeah. So I'll tell you what we're trying to do. And we're trying to take the Warren Buffett approach where we find good operators and we keep them in the seat long term. Our buy box is a good operator between 1 to 20 million, where we can come in as a group and infuse a million, couple $1 million, and then either buy them more inventory, better marketing, bigger staff, essentially infuse capital, or have them go buy a competitor, for example. And then we stay out of the operation, but then now we're joint venture partners with them. Is there like a certain term for this thing or?
I think it's called the wealth elevator. I guess you might say maybe there's the term unfunded sponsor. Sometimes that's used. We have a entrepreneur wants to buy the business, maybe has a little bit of money, has the backing of some friends and family people, some accredited investors maybe who have that money. Smaller PE firms that act like PE. So what's PE? Private equity. These are pools of money that raise money from accredited investors, pension funds, union funds, endowment funds, things like that. And they go buy middle market companies, operate them for a few years, maybe fix a few things, make some acquisitions, and they try and sell it at a higher price. That's private equity. There are smaller groups that kind of act like private equity. So it might be a guy, might be a small number of people. They throw some money together. They buy companies and they're not necessarily looking to sell in a certain period of time. They just want to buy and maybe hold forever. So I don't know if there's a specific term, but we see things like that plenty of times as well.
Yeah, I've heard the term permanent equity or friendly equity because sometimes in these private equity deals, private equity comes in, infuses the capital, but the operator is booted out in a sunset period. That's tough for the operator. A lot of my peers are small entrepreneurs, business owners. Like this is like their work of art, and they get attached to the
Well,
employees, and they create
sure,
this art of work, and they want it to
sure.
grow. They need the money, but they don't wanna be kicked out of it is part of it
Right.
too.
And there's a couple things there. So when you say infuse capital, where does that capital go? Does it stay with the company or does it go into the pockets of the seller, of the business owner?
I guess the way I envision is the operator and the investor group are now joint venture together.
But they're buying, so $1 million gets invested in the company.
Correct.
Is that seller selling you some equity that he or she owns? In other words, that $1 million goes into that person's pocket, or is that $1 million going into the business and new shares or new units are being issued, and that money is going to be used to hire people, buy equipment, things like that, in which case the owner is diluted because now you've come in as the owner. So when you say infuse, what do you mean by infuse?
There's infinite layers, possibilities, but generally speaking, the owner gets a little bit of nice payout, right? Whether that's half of the money, a fourth of the money, they get a nice little payout, right? They can go on a nice little vacation, take a ease off, but the majority of the money stays in the company, and then that owner is essentially diluted out to a certain extent.
Okay. If for the business owners out there, if you're looking at that sort of situation, I'd be very careful as well. How much money are you putting in your pocket? But what do you want to do? Do you want to create that personal liquidity or do you want to keep everything on the come line, keep growing the business? And you can do mix and match. You can take a little liquidity and keep some money in the business, but understanding what they want to do is important. Also understanding their rights. Is that business owner now a minority owner in the business? And what are the rights that business owner has? And can that business owner be forced out? Or if you are a minority owner, in other words, you have less than 50% of the business, what are your rights? And so quite often you want to make sure you have something called supermajority rights, that 80% of the shareholders or 90% or some number like that need to agree before certain capital expenditures made or before more shares are issued. So this way, somebody that might be left with 40% of the business all of a sudden can't be diluted out by the 60% owner issuing more shares and doing all this. So you want to make sure that you have sufficient control of the business. And so the most important thing is a capable M&A attorney, not the attorney who does contracts, but someone who has done M&A transactions, who has bought and sold companies for other people. Extremely important if you want to get into this.
Yeah, a lot more moving parts, a lot more decisions than like your typical apartment acquisition, which we're used to for sure.
Absolutely. Valuation is not just a static number. Valuation is an amount of money, but it's also the timing of those payments, the terms that are attached to it, and the form of consideration. Is this stock? Is this stock in a new company? Is this cash? Is this note? Is it cash? Is it US currency? Probably. Is it going to be euro or Japanese yen? or a British pound? What is the form of consideration? Understanding that is very important. And the big thing is the timing of those payments. Is all the money going to be paid right now? Or does that investor slash buyer want to make that multi-million dollar investment, but it's going to be over a period of time? Are they going to put conditions on that money? You better have certain growth, or you better have certain amount of earnings before we will invest this money, or otherwise maybe the valuation changes. So understanding all of those details, extremely important.
Yeah. And just to dig in on that timing example you gave, this is one of our big advantages. A lot of times, the business owner or the person somewhat exiting, they don't want all the money all up at the same time because they're smart and they did our capital gains e-course, which all you guys have access to if you're part of the group. You can get that at thewealthelevator.com/tax on the left side. You can sign up for that. But it'd be silly to take on $500,000 of income all in the same year. It's better to smooth this out. And if we
Sure.
can structure the deal in a seller financing mode, then we've made the deal better for us, meaning us as the PE firm coming in. And it's also better, it's a win for the seller exiting because they don't get this huge bolus of income and then they can better mitigate their taxes throughout the coming years. Maybe they do
That's
some real estate too on the side and rep status too.
late. That is a hell of a way of explaining to someone and selling it that I'm not going to give you all the money I'm promising right now. That is an absolutely fantastic way of doing it. And if you can get people to do that, fantastic. My experience has been people want the money, they'll pay the taxes, but you make a very good point that you'll have a lot of taxes, and why get socked right now with it? Maybe we can spread that out. Also, one of the forms of consideration quite often is a seller note. And so business owners say, I'm selling the business. Why am I getting 10%, 20%, whatever in a note? I want cash. Well, you've got to put that money somewhere. That money's got to go to work. And maybe in the right situation, maybe keeping a piece of that money in the company that you know makes sense. You're going to earn some interest on it, probably higher interest than a typical savings product right now. So you might be getting 8, 10, 12% on that money. You might as well keep some of that money. And of course, if it's debt, you're higher up on the food chain in the event of a liquidation. So you've got to put that money somewhere. You might as well keep some of it with the company. Why not?
Yeah, and that's where that was how I was able to dangle the carrot to get Bill on the podcast here today. People come to us for real estate, I think, for the most part. And they've owned real estate and they know the power of the passive losses. For the ones that do own businesses, they have a pretty good understanding of taxes. And they have a great way to get passive losses to offset their transaction. And they're open to other deals like the seller financing thing, where most business owners, first generation multimillionaire who created a business, they typically are really good operators, but not the best investors, certainly not real estate investors. That was the reason for putting a podcast out there like this. The people in our community are a lot open to these ideas and may want to sell and they may want to expand the pie for them. And maybe talking to Bill might be a good thing here. You can make the connection, but let's move this conversation a little bit. Like you mentioned, you're not stock bond mutual fund guy. Neither am I. I'm not into traditional investments. I like real estate where I'm the direct owner or this M&A stuff where you're right there. Like most of the stuff on the stock market or when you go through an investment or like a Morgan Stanley, you're getting their bloated REIT or their bloated fund. Maybe talk to us a little bit about, do you do real estate or do you have the philosophy of I know M&A really good. I know how to run businesses and I stick to what I know, right?
I know M&A, and so I make my money from selling. I have investments, but I tend to be pretty conservative with the investments, just a lot of bonds and things like that. So I like to hold on to the principal. I think people have to understand that too. Two types of investors. There's the blue sky. I'm willing to risk principal for sky's the limit. And there's others that, hey, I want a good, decent return, but I want to protect my principal. I have real estate. I have a house. That's it. And that's enough for me. But yeah, I like to keep things liquid. I like to keep things simple and in front of me in terms of my investments.
Yeah. So we call this the barbell approach where the barbell is uneven on, there's nothing really in the middle, but it's on the two ends in terms of you've got a lot of safety stuff, bonds. Personally, I'm set up the same way. Got a lot of life insurance, which is essentially the same thing. Low risk, low return. But we kick ass on the other side with venture capital, private equity, direct real estate. And you and I don't really have the standard traditional investments in the middle, which I think most people are. It looks the opposite of a barbell, whatever that is, only in the
Yeah.
middle, right?
Yeah, exactly. Yeah.
But I guess I'm hearing from you, you know what you know, you're in the business and you stick to what you know.
Yeah, I'm not big on the speculation. And the older you get, you realize if you lose money, you have less and less time to make that up. When you're young, you can be as crazy as you want and take as much risk as you want. When you get older, you start thinking, I've got enough right now. I don't need to go buy a jet airplane in an island and stuff like that. That's not going to appeal to me. I just want to live a comfortable lifestyle, and at some point, I'll retire in a few years and go do something else for a while.
Yeah. So if an investor normally does the traditional investments, they may see mergers and acquisitions as private equity risky because they're getting involved in a business. But maybe talk to us a little bit about why you feel comfortable with it. I think maybe it's somewhere in the details in underwriting P&Ls. Like what would you tell that individual?
If you want to buy a company, you have to look at, first of all, what are you trying to achieve? What is your goal with this investment? Maybe it's a business, maybe you have an opportunity to get into a business that you really like for whatever reason, and you've got some money and it's just a fun thing to operate. Maybe you want to do that. If you want to get into operating or owning a business rather, then if you've got the kind of money, you can get into a private equity fund that invests in middle market companies. Maybe that's the way. And you're going to have to pay those private equity people, of course, to do that. What do you want to do? Maybe you have a young family member or friend of the family, someone in his or her 20s or 30s, and that person wants to be an entrepreneur and maybe has found a company that he or she could buy, but needs some more money. And so maybe you can be an owner of a business that way, where you're going to come in and provide some of the capital to make that acquisition, trying to find something that's proprietary, where you're the only bidder. That's where you want to be, but that is far easier said than done to be able to do that.
So last question, a fun one here. You see a lot of these deals where the owner gets cashed out and retires. What is the normal number that people who were average people prior to, what are they shooting for is I got enough. What's the number? And then for fun, what do you see them go splurge on the first thing?
The number is, I think it's tough to grasp. I think it's called infinity. I think that's what they're looking for. It really is going to depend on each individual, what they want, what they have. I do recommend that they work with a wealth advisor and come up with a plan so they know what their life is going to be like after they sell the business and retire. And if they have a hole that they have to meet, if we can hit that hole, then they're going to live the way that they want to. Okay, maybe if the proceeds are coming in less than what they were expecting, maybe they have two houses instead of three, so they can make some very discrete, specific decisions because of that. In terms of the number, I've seen people, I'm going to get a little more than $1 million and I've got a little less saved up here. That's more than I need. I'm delighted. And others, 5, 10 million isn't enough. So it's really going to depend on the individual. As far as splurging, I don't know. This is one of the sad things about my work. When the deal closes, I am persona non grata. I go from being the most important person, the quarterback on the transaction, and now it's closed. I get paid my fee and the door slams in front of me. Sometimes I see, I've played golf with some of the business owners and stayed in touch, but I couldn't tell you what the big splurge is. Again, it's whatever their goal is, how they want to live life. Quite often they leave the cold climates and they move to Arizona, Florida, places like that. They'll travel, but it really depends on the individual. So I don't know if I can give you a good answer.
That's insightful, right? I think most of the people listening under $10 million net worth, perceptively, the number is normally around 5 million is you're good enough. But I think the guys that Bill's connecting with, the guys who own multi-million, $20 million companies, what I notice from entrepreneurs and owners is you start to get on this hedonic treadmill a lot where your monthly spend rate is not 10, 5,000, 10,000 a month. It can be it can escalate extremely quick. Most of you guys listening out here, when you guys come to our annual retreat, you guys aren't staying in the fanciest hotels. If you're wine drinkers, you're drinking the $40, $50 prisoner wine. It's sort of good, but budget. But you guys know there's $500,000 bottles of wine out there, and you extrapolate that to all the things that you spend your money on. And it's for entrepreneur. I've been lucky enough to not change my lifestyle one bit since the last 5, 10 years ago, but that's something where when you got money, it's that hedonic treadmill. It's a word of caution for everybody here. Bill, why don't you get your information out there? Appreciate it.
My pleasure. You can always find me at billsnow.com. That's my website that I will have until the day I die, and then I'll pass it off to somebody else, and you can talk to my heirs in a number of years. I am with Focus Investment Bankers, so we are a good sized middle market investment banking firm, and we have people across the country. So we've got about 45, 50 bankers at the firm. So always happy to field questions. Somebody has a question about how to write a book, how to sell a company, want to talk to me about selling a company or making acquisitions, please feel free to reach out to me and be very happy to talk with you.